It's July 1974 in Washington, D.C. Federal Reserve Chairman Arthur Burns is about to step into a FOMC meeting to share his thoughts on America's economy. But it's not looking good, not at all. While he's been trained to remain calm in public, Arthur Burns is worried. He's feeling pressure from every angle, especially from President Nixon's administration. Since taking on the role to lead America's central bank 5 years ago, Arthur Burns has become one of the most powerful men in the world. Politicians, economists, investors, and business leaders all over the globe pay close attention to his every word. The US dollar is the global reserve currency, and Burns' monetary policy dictates the quantity of US dollars in circulation, which in turn impacts inflation, jobs, and GDP growth. Burns knows the world won't like what he has to say today. The Fed has failed miserably at its two key objectives: to keep prices stable and to ensure Americans are employed. With inflation at 12.3% and unemployment at 7.2%, the US economy is spiraling out of control. And for the first time ever, America has entered a period that Keynesian economists thought was impossible. A period of stagnant economic growth and high levels of inflation. But the 1970s won't be the last time the world will witness stagflation.
Everyone is talking about inflation.
Inflation.
It is not just record inflation that is proving to be a headache for global economists. Analysts are also afraid of stagflation.
Are we close to having stagflation?
Yeah, we are in stagflation.
We are.
Inflation is at a 40-year high. The US has now seen 2 consecutive quarters of declining GDP. Consumer spending is starting to cool off, and J-Powell is determined to keep raising rates even if it leads to a hard landing and reffing the whole economy. Past performance is not indicative of future results, and history doesn't repeat itself, but it definitely rhymes. Stagflation is a brutal beast, and it will destroy thousands of jobs and businesses. But fear not, this is your stagflation survival guide. Stick around until the very end, where I go through 7 practical tips on how to survive what might be the worst downturn in modern times. Let's go. In the classic book, The Art of War, Sun Tzu writes about the importance of understanding your opponent. If you know the enemy and know yourself, you need not fear the result of 100 battles. In order to figure out how to slay this nasty stagflation beast, we need to first get real close and observe its every move. We need to understand how the beast is born and how it behaves. We need to get so close that we can smell it and feel its breath on our skin, while keeping enough of a distance not to be seen and get caught in its destructive path. The term stagflation was first used by British politician Ian MacLeod during a speech to Parliament in 1965 when the UK was experiencing a period of simultaneously high inflation and high unemployment. MacLeod said, "We now have the worst of both worlds, not just inflation on the one side or stagnation on the other, but both of them together. We have a sort of stagflation situation, and history in modern times is indeed being made." The mere idea of stagflation was a big deal at the time because it was believed to be an impossible phenomenon, especially by economists who adhered to the philosophy of John Maynard Keynes. In order to understand the Great Depression of the 1930s, Keynes developed a microeconomic theory which argued that increased government spending and lower taxes stimulate demand. Known as a demand-side theory, Keynesian economics suggests that the primary factor that drives economic activity is the demand for goods and services. When consumers stop spending during a recession, the government should step in and fill the void to kick the economy back into gear. Many models were developed by Keynesian economists, with a famous example being the Phillips curve, which predicted an inverse relationship between unemployment and inflation. Policies designed to decrease unemployment were expected to increase inflation, and in order to decrease inflation, you would have to increase unemployment. Keynesian economics dominated economic theory during the first half of the 20th century, and it served as a foundation for Franklin D. Roosevelt's New Deal in the 1930s. But one economist rejected Keynesianism. Milton Friedman argued that monetary policy was more important than fiscal policy, and that free markets were more effective than government intervention. Friedman's economic theories became known as monetarism. Monetarists advocated that the control of the overall supply of money available to banks, businesses, and consumers would be a better approach to boost economic activity instead of government spending. Friedman argued against the Phillips curve and said that the inverse relationship between inflation and unemployment would only hold true in the short term. In the long run, however, the Phillips curve would become vertical at the natural rate of unemployment. What exactly does this mean? Well, human beings are rational. Once we realize that inflation will be high for the foreseeable future, similar to the situation we're in today, consumers will factor in higher prices when deciding how much to spend versus save. If you expect inflation to be 8% next year, you're going to ask your boss for a higher salary, which means he will be able to hire less people. As a result, higher inflation will only lead to lower unemployment up to a certain point. Eventually, we reach a natural rate of unemployment, which is the lowest possible rate of unemployment that can occur in an economy. It can never drop all the way to 0%. Based on the theory that people will come to anticipate higher inflation, Friedman held a presidential address in 1967 and predicted that the US and other countries will fall victim to stagflation. And he was spot on. Friedman's theories were so influential that he won the Nobel Prize in Economics in 1976, and the economists described him as the most influential economist of the second half of the 20th century, or possibly all of it. Okay, now that we've explored the two dominant economic theories of the 20th century, let's observe how the vicious stagflation creature was actually born last time. This will allow us to compare similarities and differences to the beast we're dealing with today. Economists primarily blame stagflation on two reasons. Number one, supply-side shock. A supply-side shock typically occurs when there's a sudden spike in the price of a universally required commodity such as oil. Why does this matter? Well, oil is the lifeblood of industrialized nations, and it's become the most important source of energy since the mid-1950s. Oil helps supply energy to businesses, heats homes, and provides fuel for vehicles and airplanes carrying goods and people across the world. An increase in the price of oil will increase the operating costs for pretty much every business. Take Amazon as an example. Higher oil prices will make it more expensive for Amazon to run its business and ship packages to customers. As a result, Amazon will pass these higher costs on to consumers by increasing prices and laying off workers. This causes both inflation and unemployment to rise. A decrease in real incomes forces households to cut back on spending, which causes economic growth to slow down. To accommodate less consumer spending, Amazon will reduce its production levels, which leads to even higher unemployment. The oil price shock was the fundamental cause, but its impact reverberates across the whole economy. The oil crisis in the 1970s is an excellent example of this. In October 1973, Saudi Arabia and OPEC members issued an oil embargo. The embargo was targeted at Western countries who had supported Israel during the Yom Kippur War, and it led to a global oil supply shortage. By the end of the embargo in March 1974, the price of oil had quadrupled from $3 a barrel to $12. This led to higher production costs for businesses, which forced them to hike prices and lay off workers. The second primary cause for stagflation is poor economic policies. Inappropriate monetary and fiscal policy by a government and its central bank can wreck a country's economy. Just look at Zimbabwe and Venezuela, two countries who have struggled with poor policymaking and high levels of inflation for decades. But poor policies can of course be a problem for any country. Fine-tuning an economy using fiscal and monetary policy is tricky, which is why the theories of Keynes and Friedman are so important to understand. Governments have a lot of power. For better or for worse, they can increase taxes on businesses and raise the minimum wage, which impacts business profit. Higher taxes and higher labor costs means that Amazon needs to raise its prices, which leads to higher inflation and higher unemployment. Central banks have a lot of influence too. They can decide to keep interest rates low for too long in an economy that's running close to full capacity, which in turn can trigger a spending boom that drives prices higher. As a result, workers demand higher wages without increasing their productivity levels, and so Amazon passes their increased operating costs to consumers, which leads to even higher prices. In the 1970s, Fed Chairman Arthur Burns, who we met at the beginning of the episode, advocated for loose monetary policy. This, in combination with high government spending, led to strong economic growth with low levels of unemployment. But prices were already on the rise, partially because of the suspension of the gold standard in 1971. After the oil shock in 1973, prices rose even faster. It set the perfect stage for the dreadful stagflation beast to be born. Let's take a quick breather here. Do you notice any similarities between the 1970s and today? We've created the perfect environment for another stagflation monster to be born. We experienced two supply-side shocks recently: the COVID-19 pandemic, which disrupted global supply chains, and the Russia-Ukraine war, which sent global oil prices skyrocketing to more than $120 per barrel. Both events stifled the supply of commodities and goods. For the past 15 years, we've also lived in a record low interest rate environment. And as we've discussed, stagflation loves loose monetary policy. That's how the beast feeds itself and grows. Central banks' dovish monetary stance as a result of the 2008 financial crisis and the pandemic has been the perfect setup to create a nasty monster. There are some differences too though. We're less reliant on oil today than we were in 1973, and unemployment is still relatively low in the US today. Unemployment will surely rise as the Fed keeps raising rates, but a lower starting point should give central bankers more room to kill the beast. So how do we actually actually slay the beast and survive. Once stagflation is running loose and wreaking havoc, it's incredibly difficult to kill it. Last time around, Paul Volcker, who took the reins as Fed chair in 1979, had to engineer 2 recessions in order to slash spending and force inflation down from its 13% level. Volcker initially tried to raise rates incrementally, but this didn't work, so he was forced to hike rates all the way up to 20% by June 1981. Volcker eventually managed to bring down inflation below 4% by 1983, but it came at the cost of sky-high unemployment at 11% and super volatile financial markets. So how do we prepare for this? To put it briefly, buckle the fuck up. It's not going to be a smooth ride, but it is one that you can get out of unscathed if you follow these 7 practical tips. So let's go through them one at a time. Number 1, optimize for cash flow. The era of growth at all costs is over, and cash flow is once again king. Get rid of any unnecessary expenses and bring your business and personal finances to cash flow positive as soon as possible. Build that cash buffer so you can double down on growth once the beast has been slayed. This is all about survival. Number 2, avoid debt at all costs. Interest rates will continue to rise until inflation starts coming down. Nobody knows exactly when this will happen, not even the Fed knows, since they keep changing their mind, but one thing is for sure, they're going to be aggressive. Jerome Powell recently said that we must keep at it until the job is done, which reminds me of Paul Volcker's autobiography titled Keeping at It. If Volcker is a source of inspiration for Powell, well, then we should prepare for rates to rise quite a bit. You don't want to be caught holding debt on your balance sheet with a variable rate as the battle against the beast rages on. Number 3, build amazing products. If you build something that genuinely adds value to people, you'll win in any market condition. Bed Bath & Beyond, Starbucks, Microsoft, Apple, and Victoria's Secret were all founded during the 70s when stagflation was running wild, and they're still around today. VCs are sitting on $290 billion of dry powder, which is more than ever before. While they might be reluctant to invest during times of uncertainty, they will definitely throw money at amazing founders and startups, especially if you're reasonable with valuation. Number 4, subscribe to this channel. This is definitely the easiest one, so let's just knock it out of the way. Consider it equivalent to stabbing stagflation in the guts. Number 5, boost your productivity. There's no substitute for hard work. Layoffs are coming, and while it might affect you even if you're a top performer, you can stack the odds in your favor by proving yourself to be invaluable at work. Whatever you do not quit your fucking job. Number 6, invest in stagflation-proof businesses. Stagflation destroys equity, fixed income, and cash assets, which leaves us with few options for shelter. But some assets and businesses are better suited than others. Consumer staples and real estate investment trusts typically hold up pretty well. People still need to eat and somewhere to live. And these businesses can typically pass on higher costs to consumers with limited impact on earnings. Gold is of course also an asset to consider. As a store of value, gold tends to perform well during times of high volatility and when stocks and bonds get wrecked in tandem. Number 7, look for signs that the beast is dying. The investor in me never tries to time the market, but the business operator in me always keeps a pulse on what's going on, so I know when to get aggressive with hiring, product dev, and marketing. Keep a close eye on the 10-year yield, consumer sentiment data, and which way unemployment and inflation is ticking. Recessions suck, but we'll get through it. Financial and debt cycles are a natural part of life. I'll keep cranking out videos regardless, so definitely stick around. We can watch our portfolios evaporate together. It'll be fun, and it's a better use of your time than watching Netflix or HBO. They're dying anyway. Watch this video next to learn why streaming services are struggling and what they need to do to turn things around. Thanks a lot.